In this video, we're going to look at the concept responsibility account. Now, we're talking about a concept. So it's a way of looking at a company and dividing it up in terms of responsibility centers. This part has a lot to do with theory. Now, when we have different responsibility centers, we are going to report the costs by each center. And the costs that we're going to report are those that are directly under the control of a manager. Concept of responsibility accounting: costs and revenues can be directly associated with a specific level of management responsibility. These costs and revenues are controllable at that level of responsibility. The budget data can be developed for evaluating the manager's effectiveness in controlling both these costs and revenues. Now, the definitions: a responsibility center is any part or segment or subunit of an organization whose manager is accountable for a specific set of activities. Responsibility accounting, then, is the accumulation of the data that measures the plans and the budgets and compares the budgets to the actual for each responsibility center. Now, first of all, we must make a distinction. We are only reporting on those costs that are controllable by the manager. That means they're under the discretion of a manager. He can change those costs. Some costs he cannot change. They're not controllable for him. For example, the rent on the subunit that he is operating. That was negotiated by someone higher up in management, not him. So the critical issue here is controllability. And the other thing to keep in mind is that all costs in an organization are controllable by somebody in management. The higher up in management that you go, the more the costs are controllable by you. All right, so now, for example, we're going to look at a responsibility reporting system and the different layers in management. We start at the bottom. It's bottom up. Here we have department managers. Department managers in fabricating, assembly, and enameling. They each will get a report every month comparing their budgeted costs against their actual costs. And in that way, and the variance between the budgets and the actual. Now, at the plant level, the plant manager here, who is responsible for all three of these departments, well, he will receive a report from each one of them. And he will also have a report on his performance and how well he helped the managers in these three areas control their costs. Now, going up the next level, we have a vice president of production, and he's responsible for the production in all three of these plants. He influences the managers to keep costs under control for those three plants, and he too will then have a report from production as to how the managers under his management control costs. Now, we also have the same thing going on maybe in marketing and over here in purchasing. The same kind of reports going. The senior manager then gets the reports from the purchasing, the production, and the marketing department. So, the responsible reporting system helps you to compare the manager's effectiveness in controlling manufacturing costs. The reports themselves back to the departmental managers. You see down here just the fabricating department manager. Here, this report looks very familiar to you. It's the budgeted against the actual, the controllable cost, direct material, direct labor, and overhead. Over here we have an unfavorable variance for materials, a 1,000 unfavorable for labor, and so on. So this one would bear investigation by the manager in this department, but nevertheless what we're talking about is a reporting system. So now his budgeted and actual cost and variance is part of the report that the plant manager in Chicago receives. He receives the report from the fabricating manager, a report telling them how well the enameling manager did and the assembly manager. And that, plus other costs in his department, he too has a variance analysis here. He influences these three managers down here. And how well did he do? Well, you can see that there was a huge unsatisfactory or unfavorable variance for the fabricating, another one for enameling, and a favorable variance for assembly. So he would look into why these two are unfavorable. Nevertheless, his total budget was 304. He came in at 309. He is unfavorable. But this report then would go up to the next level. Here's the plant level. We have three plants, Abu Dhabi, Dubai, and Fajero, if you will. And here's the, in this case, the Chicago plant, and the unfavorable variance in here. You see the Detroit plant did okay, but the Chicago and St. Louis plants were a little off, and therefore his total favorable variance is 7,300. He would look into why these guys are not performing at the level they should be, and then his totals would be carried up here to sales, production, and finance. And you can see that sales has an unfavorable variance, but it's very small. Actually, production's total variance is actually very small too. So this is the result. Each one of these managers gets this kind of report on that. Now, the types of responsibility centers. There are three types. There's the cost center, and there's a profit center, and an investment center. Now, a cost center is responsible as the kind of center that only has expenses. There are no revenues. Think of the maintenance department, or let's take Carrefour as an example. We've all been to Carrefour. The cleaning and maintenance in Carrefour would be an expense center or a cost center. That is, the maintenance doesn't do anything to generate any revenue. It's there to service the other departments. So its performance would be evaluated based on how well it controlled costs. Now, a profit center is a kind of responsibility center that the manager is responsible for controlling the costs, but also influencing the revenues. So in Carrefour, we have a number of responsibility centers. For example, a vegetable department could be a responsibility center, the pharmaceutical department, the clothing department. The managers in those departments are responsible for influencing sales, but also controlling costs. So now we can produce a report that tracked how much they sold in terms of vegetables or pharmaceuticals, drugs and things like that, and look at their fixed and variable costs that are in that department, and we can produce a profit statement. Sales minus of the costs gives me the profit, so I can compare the profit in the vegetable department to the profit in the clothing department and the profit in the pharmacy department. Yeah. Now we can go one step further. We have three Carrefours here in LA. El Jimmy, Sanaya, and the Bawadi Mall. They all are different sizes. Now what we can do is that we can look at the whole Carrefour as being an investment center from the senior management's point of view. We can look at the revenues for the generated at El Jimmy and Sanaya and Bawadi. We can subtract the expenses so we can have the profit generated at those three centers. And then we can compare that profit against the amount of money invested in each one of these. Not all the Carrefours would be the same size. So now we can have what's called a return on investment for that. So there you have the three samples: the cost center, the profit center, and the investment center. Now the responsibilities for the cost centers is they're responsible to meet the budgeted goals. Okay. And therefore, this report is going to compare the actual controllable costs against the flexible budget. Now, you all know about the flexible budget. This, again, is familiar to you. This is a flexible budget report for the finishing department. Over here, the budget, indirect materials, labor, utilities. Here, the actual, and here are the variances. Now, for profit centers, we add the idea of budgeted and actual controllable revenues. And now we come up with, we have the revenues, we have the variable costs, we have the fixed costs. And so we come up with a contribution margin then. Now the manager generally is responsible for the variable costs in the department. So sales minus the variable costs gives me contribution margin. Now there are some fixed costs that he has a control over, so we subtract the fixed costs and we come up with what's called a controllable margin. All right. Now let's see, the controllable margin then is the contribution margin minus controllable fixed costs. For example, here we have the Marine Division budget, 1,200,000, actual 1,150,000. So this manager did not achieve his budgeted sales of 1,200,000. He's 50,000 under or unfavorable. That's output. So when we don't achieve budget, when we're talking about output, that's unfavorable. Now the costs. Cost of goods sold, 500,000 was the budgeted, 490 is what he came in at, so that is favorable. We didn't spend as much as we thought we would spend, so that makes that favorable. These are inputs. So when you are under the budget in inputs, that's favorable. Selling and admin, again, favorable. But you see now the way we do the report. Sales minus variable costs gives me the contribution margin. My budgeted contribution margin was 540,000. The actual is 504,000. From there, we subtract only the controllable fixed costs. In this case, the cost of goods sold and the selling and admin, so that we have what's called a controllable margin. So this is a new concept for you. You know about contribution margin, sales minus variable costs. A controllable margin is sales minus variable costs, which is contribution margin, minus controllable fixed costs. And as you can see, the budgeted was 360, the actual came in at 324. So what we have is a 36,000 unfavorable variance. Now, for investment centers, we are looking at one more thing, and that is how much money was invested in each of these responsibility centers. So now, in our example of Carrefour, the responsibility center we're looking at now is the whole Carrefour center in Sanaya versus Aljimi versus Bawadi. They're all different sizes. Because they're all different sizes, they have different amount of assets. The bigger the company, the bigger and the more the assets. So now we look at what we call return on investment, ROI. You've heard about that. And every time you hear about return, what we mean is profit on over investment. That's what ROI. So in computing ROI, we are going to the investment that we're going to pick up, the current and fixed assets of the responsibility center. So we look at the current and fixed assets of Aljimi, Sanaya, and Bawadi Mall for Carrefour. And then we will relate the controllable margin and divide that by the average operating assets. That is, average mean what they were at the beginning of the year plus what they were at the end of the year divided by 2. And so in this case, assuming we had a controllable margin of $1 million at this one responsibility center and assets of 500,000, then we would say that this investment center or responsibility center achieved a 20% return on assets. Now, the Sanaya Carrefour may have 1.2 million controllable margin, 600,000 in assets, and it would have a different ROI. And the same thing with Bawani Mall. But here is the report. We just added another layer down here, which is return on investment. So here's the investment center report, responsibility report, the sales again, the costs, the controllable margin. Let's subtract the fixed costs, gives me, contribution margin. Subtract the fixed costs, gives me controllable margin. Now, we take the controllable margin as a percentage of the assets. In this case, we're going to say they're 2 million. And his budget was for 15, his budgeted ROI was 15%, 300,000 divided by 2 million. He actually came in with a controllable margin of 264,000. So 264 as a percentage of 2 million is 13.2%. So you can see that he did not achieve his targeted ROI. He is under. Now we would do this for, or senior management would do this for every division. So if we're talking about, let's say we're going to be opening a superstore in Abu Dhabi and Carrefour, and they're going to select one of the managers from Al Ain to run that superstore. Well, they're going to compare the ROI achieved by the manager at Al Jimmy to the manager in Sanaya to the manager in Bawani Mall. And this comparison is all fair because even if the Bawani Mall is larger, the controllable margin should also be larger. The more assets you have, the more controllable margin you should be able to generate. But when you come with a ratio of return on investment, then you see we get an equal footing between all three managers. So this is performance evaluation, and that's what we're talking about. ROI is evaluation of operating assets, and it's also the controllable margin. So now there are ways in which you can improve the ROI. You can improve the ROI firstly by increasing the controllable margin, or secondly by reducing the average operating assets. So we'll look at increasing the controllable margin. And in this example for the laser division, we have sales of 2 million, variable costs, we have contribution margin of 900. Controllable fixed costs of 3, so controllable margin of 600,000. Average operating assets of 5 million gives me an ROI of 12%. Now, I can improve on that 12% by improving this, the controllable margin. And I can improve the controllable margin by improving the sales and hold everything else same percentage, or by not improving the sales but reducing the cost at that sales level. So let's look at those two separately. First of all, increasing sales. If I increase sales by 10%, sales will go up 200,000. Contribution margin will increase 90,000. And therefore the controllable margin goes from 600 to 690,000. Now 690,000 is a percentage of 5 million. I have improved my ROI from 12 to 13.8%. So that's an improvement. I can also do it by reducing the variable and fixed costs. If I reduce them by 10%, then my total costs will go down 140,000. If my total costs go down 140, my controllable margin goes up by 140. Now, if I take 740, my new controllable margin as a percentage of the 5 million, you can see I get a whopping increase in my ROI. It goes from 12 to 14.8. So a manager can do a combination of both, increase the sales and decrease the costs, and that's both under his control. And in both ways, he would, as this demonstrates, increase his ROI. And then the third way is to reduce the number of assets that he is using Now, in this case, he had before this, he had 5 million in assets. Well, if I can reduce the assets without affecting my sales, then my controllable margin remains the same, 600,000, but my operating assets go down, my ROI goes up. So you see, a manager at this level is handling three things at all times. He's trying to promote more sales, control costs, and make sure that the assets he's using here, the operating assets, are no more than what he really needs. And in that way, he will maximize his ROI. Okay. And that then concludes this. This is all about performance evaluation. When we look at how well a division is performing or a responsibility center is performing, we're actually evaluating how well the manager is doing that. And we judge the manager's performance based on the costs that are directly under his control. And there are, again, three types of responsibility centers: a cost center, a profit center, investment center. Now keep in mind, we're comparing actual costs in these reports to the flexible budget data. And we're dealing only with controllable costs. And when we talk about investment or profit centers, we talk about a new thing here. The profit center is a contribution margin, sales minus variable costs, but also minus controllable fixed costs gives me what we call controllable margin. All right. Now the ROI, return on investment, return means profit as a percentage, so profit over investment. And the profit we're going to use is not the same profit as we talked about on the income statement. The profit is the controllable margin divided by the average operating costs, assets. And that concludes our video for today.